Business valuation. Demystifying the art and science of company worth. Business valuation is often considered the cornerstone of corporate finance. From mergers and acquisitions to public offerings, succession planning, and even strategic business reorganization, the process of valuing a business is fundamental. As a CFO, you're tasked with not just understanding the numbers, but also the methodologies, assumptions, and market conditions that influence a company's value. In essence, business valuation is both an art and a science, combining quantitative analysis with qualitative insights to arrive at a justifiable value for a business. This section aims to guide you through the intricacies of business valuation, emphasizing why it's an indispensable part of a CFO's skill set. The core methods of valuation. 1. Market capitalization. For publicly traded companies, the market offers an immediate valuation in the form of market capitalization, calculated by multiplying the current share price by the total number of outstanding shares. While convenient, this method is heavily influenced by market sentiment and may not always reflect intrinsic value. 2. Comparable companies analysis, CCA. This involves valuing a company by looking at the valuations of similar businesses in the same industry. Metrics like P/E ratios, revenue multiples, or EBITDA multiples are often used as benchmarks. 3. Discounted cash flow, DCF. This is one of the most theoretically rigorous methods, relying on the present value of the future cash flows that a business is expected to generate. While the DCF model provides a robust framework, it's also highly sensitive to assumptions about future growth and discount rates. 4. Asset-based valuation. This approach values the company based on the sum of its parts, i.e., its assets. The asset-based valuation can be done on a going concern basis or a liquidation basis, depending on whether the business is expected to continue operations or not. 5. Earnings multipliers. This approach uses metrics like the price-to-earnings (P/E) ratio to estimate company value based on its earnings. It's often used for companies with stable and predictable cash flows. Why business valuation is crucial for a CFO. Strategic planning. Valuation is central to strategic planning, informing decisions from market entry to product diversification and mergers and acquisitions. Capital raising. Whether you're considering an IPO, private equity investment, or debt financing, a solid valuation is crucial for negotiating favorable terms. Internal performance metrics. Valuation metrics can serve as internal benchmarks, helping to set performance goals and measure achievement against them. Risk management. Understanding the variables that most significantly impact your company's valuation can provide insights into the associated risks and how to manage them. Regulatory compliance. In transactions like mergers, acquisitions, and divestitures, a credible valuation is often a legal necessity. For public companies, disclosures around valuation methods and assumptions are typically required. Challenges and considerations. 1. Sensitivity to assumptions. Methods like DCF are highly sensitive to assumptions like discount rates and future growth, which are often difficult to estimate precisely. 2. Market volatility. Methods based on market multiples can be influenced by broader economic conditions and investor sentiment, often leading to short-term fluctuations. 3. Complexity. Businesses with diverse product lines, markets, and financial structures may require a blend of valuation methods, complicating the process. 4. Qualitative factors. Factors like brand value, intellectual property, and market leadership can be challenging to quantify, but are crucial for a comprehensive valuation. Business valuation is an ongoing process rather than a one-time event. As market conditions, business performance, and growth prospects change, so too will the company's value. For a CFO, the ability to understand, communicate, and apply the principles of business valuation is crucial. Not only does it influence strategic and financial decisions, but it also serves as a vital tool for stakeholder communication, risk assessment, and long-term planning.